I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, Jim, good to be with you.
The U.S. business community seems to be pretty excited over the election of Donald Trump.
Yeah, it's, of course, we've mentioned before, and the whole world knows that it was a huge and shattering surprise that he won. Our work indicated that it was, well, we've been calling it the American Spring, as being a reform of excessive government. So it's come in, and people are seeing that really this is going to be a massive reformation. And so what you have is, on one side, a diminution of the threat of arbitrary government coming along and, oops, they're now suddenly doing this and they're now suddenly doing that. Of course, always in the best of reasons. And then what you have is the diminishment of risk of government intrusion, and then turning loose more of a freer market. And this has showed up in the bank stocks, which have been fabulous. They've been rallying since earlier in the year with the yield curve. It was in June when the yield curve turned from flattening to steepening. And steepening is very good for bank spreads. So they've been making money. So you had a positive trend for bank stocks. And then with the election, the discovery of such a profound change, well, they've gone, well, virtually straight up. You've had Goldman Sachs, the big one. It is, you look back on a chart, I think, to about 1996, and there's nothing like it. And the RSI is up to the highest ever. But our bank index, BKX, has been a much longer run on that, and its RSI is getting up there. So, but what it is very exciting to watch. You've had many constraints on the banking system designed by the U.S. Congress, particularly a Democrat Congress, and they frankly don't like banks, business, and they don't like a lot of things, and it gets into their legislation. So this is going to be, Jim, a fabulous reform of many government excesses. And what you've seen is, with the process of Trump building a cabinet, various intrusive people such as Al Gore, who is probably flipping right out, got through to his daughter, Ivanka Trump, and then had a meeting with her, and then Trump himself joined the meeting, and so Gore had a chance to make his pitch, and then he goes out and appoints Pruitt to the EPA. So he's listening to him, and then yesterday, was it, or the day before, when the actor, Leonardo DiCaprio, who has been going around claiming to be a climate expert, and even had a meeting with him, and the appointments are not being influenced. I think in the case of Scott Pruitt to the EPA, it is really a sound, strong man to head that one up. So this, as I said, is having a terrific play in the financial markets. One, risk from government diminished. Two, intrusion by government constraints. And you've had really strange things going on with so many rules and regulations which constrains business expansion. Then you got another set of economists who look at GDP growth and say, oh, this isn't as strong as it should be. They arbitrarily decide it should be better, stronger growth. And then they got this idea that if the Fed injects credit into the economy, that'll push business growth, which is not the case. And of course, all of that extra push, stimulus they called it, quantitative easing they called it, went in and drove real estate prices and financial assets to the moon, and junk and all kinds of bonds to the biggest bubble in history. And it's also straightforward. You look at it and you say, how could these agencies be so stupid? Constrain business, then say it's not strong enough, then hype the money supply, and then you get speculation in assets that they don't hope to get it in. So anyways, what is exciting here is I think all of this will be constrained. And of course, we got a trade coming up here with such a fabulous rally going on in banks. They're now getting up to some what we would call technical excesses, upside exhaustions, and as well as sequential sells. These are just starting to come in now. So somewhere in the next few weeks, this very dynamic action can complete, and you'd get a correction in the overall markets.
Now, when we say a correction, how big?
Well, I think we would just call it a significant correction. It's hard to say whether this would be a bull market top or not. We're not prepared to say that yet. So it would be a significant correction of a few months. But you can't put a percentage change on it until it rolls over. What one would want to watch for is the first week on some of these hot sectors with a lower low than the week before. Then you know that momentum's going out of the play, and then you can start to put some other technicals on it to determine how much of a correction it's going to be. But, Jim, it is very exciting markets out there.
Is this going to be similar to last year's question where we were asked about the possible drop? I mean, January, February last year, 20% drop in the markets, but then everything just skyrocketed out of there. Are we going to see the same thing where they called it hauling out the garbage?
Oh, no. That one was, that was really quite a classic sell-off, because you had the price of crude oil peaked the year before at 105, and then from about 100 in 2015, and then down it came. So crude oil was being driven down, and then with that, base metals were weak too, and that then put credit spreads to widening, and the difference between high-grade bonds and low-grade bonds. So you had that widening, which was, it was a real beat-up in the credit markets, as well as commodities, and that went right down. So what we used on that one was that often crude oil can have an important low in, January or February. Well, it was in that window. Crude fell to 26, became extremely oversold, and then we called for the big rotation with a rally out till whenever. And so, no, we're not looking at something like that. You have credit spreads are still narrowing in what appears to be a really relentless trend. And, of course, the change in administration in the U.S. will be helpful to corporate bonds, and that's how you measure the spreads. And then crude oil has been acting reasonably well. You can have a seasonal low perhaps in January. It could do that, but we don't see a huge washout in crude oil such as we had last year. So, no, this is what suggests that whatever the excesses are, particularly in the bank stocks, the banks and financials, it'll be a good tradable correction, but it isn't going to be the bear market stuff, like as you had for junk bonds and crude oil going into last January. So it's not going to be the end of a world move, but just a very good trade.
We'll have more with Bob Hoye right after the break.
GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond, recently discovered in Africa by a fellow Canadian junior, with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Boy, big gap between what we pay for gas. Calgary's 88 cents and we're $1.19.
Yeah.
So
and
it's
I
not
buy
all
91 octane for my car, and that's like 140. So.
Yeah, I know my Porsche likes that stuff too.
Yeah. Well, yeah, but it's still not as expensive as the Chevron 94.
Oh.
Octane.
Oh, I see.
But the Shell V-Power 91 octane gas does not have alcohol in it. So that's what I use.
Although in the wintertime, it's good to get the water out of the gas tank, isn't it?
Yeah, I guess that would work, sure.
Yeah.
Oh, okay. On your advice, I'm going to put the next tank of alcohol gas in.
Yeah, well, really. Yeah, and I'll just get the water out from condensation.
Yeah.
Welcome back. We're speaking with Bob Hoye. Bob, what's happening with gold? It's been on a downward slide for quite some time now.
Yeah, gosh, you know how much we like the precious metals and how important gold will eventually be in the financial equations, but you have to look at the technicals on it. And last year, going into Christmas, we had a study based that we were looking for the gold shares to begin to outperform the bullion price, and it started in December, and we wanted that to build a base, and then we were looking actually for an end of the cyclical bear market and the start of a cyclical bull. And yeah, it did come in, and it ran up until June, when the technicals just got so excessive, really overbought. So I think it was early July, when we came out with a couple of comments on that one, that the sector was very overbought and would suffer, and the term we used was a significant correction, and it would be at least, in the order of 25% for the gold stocks, and we've had more than that. And this now, we're looking at some of our tools to find a bottom in here, and the gold shares are beginning to outperform the metal price, which is a plus. And we've got a couple of technical tools in here when we would suggest to begin to accumulate gold stocks, but not yet. And because the next leg up, I think, would be pretty exciting. But, you had, like, for the stocks were, fabulous rallies, just terrific. So, anyways, there will be opportunities. We still think that this is within a cyclical bull market, and the reason being why we like the gold stocks over the metal prices is because the price of gold, it has generally outperforming like the producer price index, and that's a reflection on the cost of mining gold. And that's all you need to know about gold, are the mining costs in line with what they can get for the price of the bullion, and that has been improving. So this is where we prefer that people invest or trade in the gold stocks rather than the metal price. And what you've got here is a problem that the gold bugs have yet to really consider. And One is that they have, even the central bankers, like the Federal Reserve, assumes that it can depreciate the dollar at will. But we're in a post-bubble contraction where the senior currency goes up. And then the other half of that is that the gold bugs look at the Federal Reserve and say, yeah, these guys are going to do it. So they've made the same assumptions that the central bankers have, is that the Fed can depreciate the currency at will, but market forces are saying no. So I don't see any way of making money in gold or silver in U.S. dollar terms. Now, if you're in a country with a weak currency, then it does work. But when you're in the senior currency, which is going to remain firm, and if it gets, the DX gets above 102 again, then the next leg up will go to about 112. So, and what was the low in 2008 on this one? 71, and we're now out at 102. So the problem is a firm dollar, and one of the features of a post-bubble contraction is that the senior currency is firm relative to most other currencies. So you have to contend with that, but I don't see any of the gold bugs yet considering this as a major new paradigm. Eventually they will, but I'm very content to continue with our way of looking at things, that it's the improvement in the mining costs relative to the price of the metal that converts to earnings, and it makes the stocks go up eventually. Of course, the other problem you got is that in times of when the big market's going to go down, then the gold shares will go down as well. But at the moment, you're looking at soon here an important low for gold shares.
Right, and I remember not too long ago they thought $1,100 was the production cost of gold. Now I'm told it's perhaps $900 or $800.
Yeah, I just prefer to look at the gold divided by the producer price index, just deflate it that way. And but it's kind of complicated to look at the whole gold industry and figure out the average cost of production. But there certainly are incentives out there to improve productivity in the gold mining side. But I think it'll work out that the real price will continue to improve, and operating margins will improve, and the industry. This is where in every previous post-bubble contraction, gold mining has become one of the premier industries, because where base metal miners aren't making any money, gold miners are. So we can look at that as coming ahead at some point.
The Indian government is now seizing personal gold assets. Any sign of that happening this side of the pond?
Oh, yeah. I was on an interview the other day where there is grave concerns that the policymakers in the States and elsewhere would take a look at what the government's doing in India, and that is just totalitarian what they're doing over there, ruining so many businesses, so many people. And no, I don't think this election is going to reverse any potential for the U.S. government to go off on fanciful things like that. No, this election is going to reduce the arbitrary features of highly motivated bureaucrats. But what's going on in India is really a disaster. But I don't see it spreading to the U.S. And then if the U.S. is being reformed, it may even help impose some sort of reform on Canada. Because you take a look at Michigan and the proximity to industrial Ontario, and you've got very low property prices in Michigan. You're going to have corporate taxes dropping to 15%, and you're going to have a reduction in rules and regulations. That's going to force Canada, particularly Ontario, to get a little more practical. So the reform in the United States, as it builds, will be a positive, and it will also spread to Canada, and it's going to be fun to watch how Ottawa contends with this. I'm going to enjoy it very much.
Well, Prime Minister Trudeau wants a 12-cent a liter carbon tax, and, of course, Trump is against a carbon tax.
Oh, yeah, it's a tax. This idea of taxing carbon and that it'll do wonders to reduce the amount of carbon dioxide emissions, there's absolutely no foundation in science to that, because there is no link between changes in atmospheric carbon dioxide and global temperatures. And by the way, I did do a degree a long time ago in geophysics, of which climate, ice ages, and interglacials were very much interesting, and I've stayed up to date. So if you take a chart of the history of temperature and also the amount of carbon dioxide in the atmosphere, all they do is go, if you have like 300,000 years of chart on a 6-inch chart at the bottom, it shows like they go up and down together. But if you plot them in 1,000-year spans, you'll see that in every peak, the temperature goes down and carbon dioxide follows by 600 to 800 years. And similarly, at bottoms where the temperature starts to go up, then carbon dioxide follows by 600 or 800 years. It varies all over the place, but the main thing is that changes in temperature are followed by carbon dioxide. Carbon dioxide is not causation on this at all. So here you have, so it's just become now the only reason why this theory has been worked so hard is because it transfers immense wealth and power to governments. And they're not going to give up too willingly on all of this power and ability to tax. And again, to get back to your comment about carbon taxing, that's all it is. It's a tax that will have nothing to do with changing the climate in Canada or anywhere else. So again, this is going to come out very strongly with the Trump administration, because they're putting in, well, at least with Scott Pruitt at EPA, very practical minds. And then what I read about the advisors that Trump has on climate, these are very sound guys as well. So very exciting times, Jim.
Bob, thank you so much for chatting with us.
Jim, it's good to be with you, and we look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. If you have any questions for Bob, you can email us at info@howstreet.com. I'm Jim Gondard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.